Hello there and welcome. You are tuning into the Wild Bat podcast. This is episode 2, where we are talking about the CCPC, which is Canadian Controlled Private Corporations, which is a part of the income tax course that I have done in the prior year. Alright, let's get into it. So, a Canadian Controlled Private Corporation is a corporation that has been generally incorporated in Canada, and it has the purposes of having a substantially better tax rate, which would result in a better tax position if you're able to define the corporation as a CCPC. Most of these definitions, what you will find when it comes to taxation, is it sometimes describes what the item is compared to also what it is not, and the definition of a CCPC is no exception. So under the Income Tax Act section 125 part 7, you will find this 4-part description. The first part A, it is a corporation that is not controlled by a non-resident or a public company. So the corporation has to be a private corporation which is not controlled by a non-resident or by a public company. The private portion of it, the non-resident portion of it wants the CCPC to be controlled by a Canadian entity, whether that be an individual or a Canadian corporation, and also not a public corporation. The second part B, refers to the control being directed at what if every shareholding, every share of the corporation is owned by a non-resident or a public corporation, which we'll discuss further when we talk more about control. The shares cannot be on a stock exchange. This would also determine that it would be a public corporation. And also, an election cannot occur, generally under subsection 89 part 11. And the reason for this, which we'll cover in other episodes, is that depending on eligible dividends with GRIP and LRIP. Alrighty. The criteria, we'll dive into the greater detail. The criteria for being a CCPC is the following. It has to be a private corporation. The residency has to be the residency of Canada. Again, it cannot be a public corporation, and it cannot be controlled by a public corporation. Residency with corporations is generally defined as where the management and control is located. And if this is in Canada, then it can meet that definition. Now the next component is it has to be a Canadian corporation. Under section 89 part 1, has to be incorporated in Canada or has to be a resident in Canada throughout the period commencing June 18, 1971. The next part is the concept of control. We're going to discuss this in a later slide because it's a little bit more complicated. We'll skip to part 4, which is listed shares. It cannot have its own shares of a company listed on any designated Canadian stock exchange, such as the Toronto Stock Exchange, or on a foreign stock exchange that is designated by the Minister of Finance, generally, such like the NASDAQ. All right. Let's look at the concept of control. The first part It must not be, remember that it must not be controlled by a non-resident or a public corporation, or a combination of these groups. The first part of control refers to de jure, which is by right. When we think of control, we determine, the first thing that comes to mind is how many shares who are the shareholders? Who are the main shareholders of the company? The corporation, whoever owns the shares, the corporation is controlled by whoever owns the shares, generally speaking. They have a financial interest in the company and hence get to say what the company does. However, this is generally it isn't the only component to think about. Control can be very complex, broad, and can be manipulated in certain ways. Hence, it also extends to if there is a right by one individual or entity to either gain shares or voting control under some certain arrangement. This can result in, at any time, the corporation being controlled by another individual, but at the initial point of time not being seen to have any control. So if any entity has the opportunity to acquire shares or voting rights in the company, cause the corporation to redeem, acquire, or cancel shares in the capital stock, or acquire control of the voting rights, or even a reduction of voting rights of the other shareholders, then that person could be deemed to have owned the shares and hence control the corporation. Another concept of control is de facto control. This is determined by any manner. Generally, it's regarded as any situation in which the operations, the core reason why the corporation is in existence, is there's influence by another entity, which results in the core operations being influenced by this entity. So this could be due to a franchise or supply chain management, or maybe even the key part of the core operations is that the CEO, who may own no shares, has a very vested interest in the corporation and the operations, and could be argued that that's the CEO has the control of the corporations beyond that of shareholder control. Another component to think about is when you think about control, I guess we'll take a step back. And when we think about control, we want corporations or individuals and entities want certain corporations to be CCPCs for the benefit of tax benefits, and as a result, they, due to the criteria requirements, they may not qualify. So they may create a scenario in which they can qualify. And one example of that is if, hypothetically speaking, there is a Canadian corporation. They have one Canadian person who owns 25% of the shareholding, and then there are 10 others who own the remaining 7.5% each of the shareholding, whom are located in the USA. However, these 10 others may be a mixture of individuals and entities, and if they can constitute a group, an associated group within the USA, even though they do not have more shareholding as individuals as the 25% shareholder, Canadian shareholder, they could be considered to be one hypothetical person, and then hence they would be the group who would control the organization or the corporation, and hence the control criteria would not be met for the CPC. Alrighty, let's move on. So what's this big fuss? Why do we care about if our corporation is a CCPC? Well, the main reason is there are significantly lower tax burdens than other corporation types under most situations. Let's look at this scenario. We have taxable income of $100,000. If we can, and let's say we pull up two scenarios where we can either, number one, we can qualify and meet the criteria of being a CCPC, or it does not meet the criteria. The first component of it is, well, is $100,000. It gets taxed at 38%. This is the base tax rate. They receive a 10% abatement or a 10% deduction, which is if the income is derived within a Canadian province. The CCPC for the year ended, this example is for the year ended June 2021, they receive a 19% deduction, so 19% of the taxable income. The non-CCPC does not receive any deduction. The next component is a general deduction of 13%. Now, general deductions cannot be used for income that has qualified for the SPD. So the non-CCPC gets this deduction. However, the result still remains you're in a better tax position if you are a CCPC compared to a non-CCPC. And that's only federally. Look at the provincially. For this example, this is in Alberta. The provincial tax rate for corporations is 8%, which they both experience. However, for Alberta, if they qualify for a small business deduction, then they get a 6% deduction, which only results in a 2% or $2,000 in this case total provincial tax to pay. The combined tax to pay in this scenario results in a $12,000 tax saving or 12% tax saving, which is a big deal. There are other considerations to think about. There is a manufacturing processing profits deductions, which the corporation may qualify for. Again, just like the general deduction, you cannot use the manufacturing profits deduction if the SPD has been applied for. So, in order to qualify for the small business deduction, the corporation must be qualify as a CCPC throughout the entire year. For one day, if they do not qualify for whatever reason, then they do not get the SPD. The 90% deduction is based on the least of the three amounts. So we have to determine each of these three amounts and choose the smallest and times that by 19%, and that will be our deduction against our federal tax. Further reading, if you want to, is section 125, part 1.1. Let's look at the first part. The first part is active business income. So active business income is the income from the operations, the net income from the core operations of the corporation. We will add on any specified partnership income. The corporation may be a part of a partnership. We reduce it from losses of active business. Now these are generally occurred in prior periods, and any losses occurred in prior periods can be applied to current active business income to reduce this amount. And it's the same with the specified losses. This should give us an amount of our active business income which may be the lesser of the three amounts in which we can apply to get our SPD. The next one's a little more complicated. This is relating to if there's any foreign income. So the SPD is only for Canadian taxable income, not for foreign income. We use foreign tax credits when they've been paid to determine what foreign income we can reduce in order from our taxable income in order to get Canadian taxable income. what we do is first we have to determine if it's non-business foreign income or business income that is foreign. We base non-business income on 28% tax credits, the tax that must have been paid on the foreign income, where business income is based at what must be 25%. So what we do is we get our foreign tax credit and we times it by 28 and we times it by 100, divide it by 28, and that will result in the amount that needs to be removed from our taxable income and then added back on. Let's rephrase that. Amount we get our taxable income total. We reduce that amount. We reduce off the tax credits times 100 divided by 28, and that will result in our Canadian tax income. Look at this example here that I've written up. Tax credits of $18,000, which would result in a $64,286 to be removed from taxable income. Let's move on. The business limit. The business limit is, as defined by Section 125 Part 2, is the amount in which a corporation can use up to apply for the SBD. It's based on $500,000. Anything excess of this is for anything excessive has to be taxed at full rates, and is not allowed the SBD on it. So what happens here is, so there's not much really to say about the business limit. It's at 500,000. Generally, will be the most of that three. You know, with the ABI, Canadian taxable income, will generally be the least. If you do have a large, like a lot of profit, then it may be you might get the full $500,000 business limit that can be applied for SBD, which means you will get, quick calculation, $95,000 SBD small business deduction to reduce your taxable your tax payable. Now this has to be shared amongst associated companies. So what corporations have tried to do, and I've been in examples where they have, is they split up their operations. So just say, hypothetically speaking, I'm making and selling widgets. I could have one corporation that makes the widgets and sells it to another corporation via a transfer pricing arrangement, and that corporation does marketing and then sells the products, and then another corporation that does delivery and charges a fee to the second corporation, and all of this would result in less than $500,000 of profit per each three of these corporations. The result of which, one could argue, if this exception didn't apply, was that, well, you get a $500,000 business limit per corporation, but no, the entire the control of the whole operation, being the manufacturing, the marketing, sales, and delivery, would all be under one group, and hence would have to share the business limit. We'll discuss this in a later episode. All right, well, that's all for CCPC. It was my first episode that I wanted to create for educational purposes. I hope you enjoyed. So join me for Module 2, which will be Episode 3. We'll be talking about the principle and practice of taxation integration. We'll be discussing double tax agreements and many other whatever that may entail. Okay, thank you for joining in, and we'll see you soon.